Imagine it's 1998 and you just opened your first investment account. The internet revolution is in full swing. Tech companies with .com slapped on their names are becoming millionaires overnight, and your neighbor who doesn't know the difference between a stock and a bond just made 300% returns. You think, I need to get in on this. So you invest everything you've saved into a handful of internet stocks. For 24 months straight, watching your account balance feels better than watching your favorite TV show. Friends are asking you for investing advice now. Then, March 2000 arrives. The crash was brutal. The Nasdaq index collapsed by almost 80%. Half of all .com companies completely disappeared. Fortunes evaporated overnight. We're talking millions gone in days. Here's why I'm bringing this up. Right now, in 2025, we are witnessing eerily similar patterns. Except this time, the hype isn't centered around the internet. It's artificial intelligence. Over the next few minutes, I'll reveal 3 critical warning signs that suggest we might be heading toward another historic market collapse. Explain how this directly impacts your investments, and most crucially, give you actionable steps to safeguard your money and potentially come out ahead. Let's jump right in. Here's something important to understand up front. Back in the 1990s, the internet genuinely was revolutionary. The underlying technology was legitimate and world-changing. Yet the excessive hype and irrational optimism still created one of the most devastating financial bubbles in modern history. Fast forward to today. Everyone's calling artificial intelligence the opportunity of our generation. They might be absolutely correct. Then again, we might be watching history repeat itself with different costumes. Mark Twain famously said, "History doesn't repeat itself, but it often rhymes." Each new generation believes they've discovered something unprecedented. Yet investing legend John Templeton warned us about the 4 most expensive words in investing, which are, "This time it's different." So, is the AI revolution genuinely different from past bubbles? Listen, my goal isn't to scare you or make you panic sell everything. My goal is to arm you with clear, honest information so you can navigate this situation intelligently. Learning to recognize these patterns is exactly how you build lasting wealth, especially when mass panic hits and everyone else is making emotional decisions. Before we proceed to the first warning sign, a quick reminder to subscribe and hit the like button. It really helps me bring quality personal finance content to you at no cost. Now, let's take a look at the first major warning sign. Warning sign number 1. The corporate AI spending war. Here's something that should get your attention. The direction of the entire stock market is currently in the hands of 7 corporations. Wall Street calls them the Magnificent Seven. These companies are Amazon, Microsoft, Alphabet, Google's parent company, Meta, Facebook's parent company, Apple, Tesla, and Nvidia. Here's the shocking part. These 7 companies combined represent approximately 36% of the S&P 500 index. Let me break down what that actually means for your wallet. The S&P 500 is essentially a collection of the 500 largest American companies bundled together into one investment. When regular people invest in something called an index fund, which is among the most popular investment strategies, they're automatically putting money into all these companies. Here's the bottom line. Even if you own just a single share of an S&P 500 index fund, more than 1/3 of that investment is concentrated in these 7 tech giants. Your financial future is tied to their performance, whether you planned it that way or not. And what are these companies doing right now? They're engaged in an all-out war to control artificial intelligence. Let me show you the staggering amounts of money involved. Here's what these corporations plan to spend on AI just in this calendar year. Tesla, $5 billion developing autonomous vehicles in xAI, Elon Musk's AI venture. Apple, $10.7 billion attempting to make Siri actually useful. Meta, $60 billion building data centers and developing AI systems. Google, $75 billion essentially rebuilding how the internet works with AI. Microsoft, $80 billion backing OpenAI, the creators of ChatGPT, and building supercomputers. Amazon,
$100 billion expanding AWS, the cloud infrastructure platform that powers much of the internet. The total is around $330 billion in a single year. For context, that's larger than the gross domestic product of entire nations like Finland or Portugal. That's how much capital is being deployed into AI development. People are calling this transformation the fourth industrial revolution. And honestly, I understand the excitement. But here's where it gets concerning. This massive spending spree is essentially propping up the entire US economy right now. Remove it, and economists suggest we'd likely already be experiencing a recession. Which raises an urgent question. How sustainable is this? The spending shows no signs of slowing. Analysts project global AI expenditure will reach $500 billion by the end of 2026. Looking further ahead to 2030, spending on power infrastructure and electricity to run AI systems could exceed $3 trillion every year. These companies are absolutely desperate to win this race, and the stakes are incredibly high. The International Monetary Fund published research showing that roughly 60% of jobs in developed economies are vulnerable to AI disruption, which means that these positions could be fundamentally transformed or eliminated entirely through automation in the coming years. Whoever successfully dominates this technology first will control enormous economic power and wealth. Mark Zuckerberg publicly stated that even if Meta burns through $200 billion on AI and gets it wrong, the risk is worth taking. Why? Because falling behind in this race means complete elimination from competition. But this competition transcends corporate rivalry now. It's become a battle between superpowers. Both the United States and China view AI supremacy as essential to maintaining global leadership, and both are spending astronomical sums to ensure they come out on top. What does this mean for regular investors? Two potential scenarios exist. Scenario 1. AI fulfills its revolutionary promises, and the next 10 years mirror the incredible wealth creation of the 2000s internet boom. We're talking about massive portfolio gains and generational wealth building. Scenario 2. The profits fail to materialize quickly enough, and the same tech stocks currently inflating your portfolio become the anchor dragging it underwater. This uncertainty brings us to the second warning sign, and when I first discovered this, my jaw literally dropped.
Warning sign number 2, the circular money flow problem. I'm calling this phenomenon the circular money flow problem, and it's the primary reason I'm developing serious concerns about AI investments. Let me walk you through this step by step because it's somewhat complex, but stay with me, it's important. Here are the main players. You've got chip manufacturers, Intel, AMD, and most importantly, NVIDIA. These companies design and manufacture the specialized computer processors that make AI possible. Then you've got AI developers, companies like OpenAI, ChatGPT's creator, xAI, Elon's AI project, and various smaller players. These are the companies purchasing those chips. Finally, you've got data center operators, Oracle and CoreWeave, for example. They purchase chips too, then rent out computing power to AI companies. They're essentially the middlemen in this equation. On the surface, this looks like normal business. But when you examine how money actually flows between these companies, you'll see some serious red flags. Here's what actually happened. Microsoft's investment division pumped $58 billion into OpenAI. OpenAI immediately turned around and paid a substantial portion of that funding back to Microsoft for data center access. Microsoft took that money and bought NVIDIA chips with it. Then NVIDIA invested capital back into OpenAI. See the pattern? The money is circulating in a loop. Every time money changes hands, each company books it as revenue. Rising revenue drives stock prices higher. This creates an illusion of tremendous success that might not reflect reality. Let me use an absurd analogy to illustrate how strange this is. Imagine I meet you in a forest. I hand you $1,000 to dig a hole in the ground. You then hand me $1,000 to fill that exact same hole back in. Congratulations! We both just generated $1,000 in revenue. Now, if our hole digging operation were valued using OpenAI's current multiple, more than 40 times revenue,
our enterprise would theoretically be worth over $40,000 each, despite accomplishing literally nothing of value. Look, I'm deliberately oversimplifying to make the point. These companies aren't simply recycling identical dollars, but the fundamental concept remains valid, and recent developments have made it even more extreme. OpenAI recently struck a massive deal with Oracle, valued at $300 billion. Oracle then announced plans to purchase tens of billions worth of NVIDIA chips. Then, NVIDIA committed to investing up to $100 billion back into OpenAI, with a catch. OpenAI must purchase more NVIDIA chips to unlock that investment. Are you seeing how tangled this has become? The clear winner in all this? NVIDIA. Since ChatGPT's public launch, NVIDIA's stock has skyrocketed 1,600%. They supply chips to virtually everyone: Microsoft, Meta, Google, Amazon, OpenAI, Oracle, the entire ecosystem. Then they channel money back into the same companies buying their products. It's essentially paying your customers to purchase from you. This dynamic could be creating artificial demand that doesn't represent genuine market needs. Here's my simplified summary. NVIDIA manufactures the tools. Oracle supplies the workspace. OpenAI does the digging. And they're all collaborating to persuade investors that there's treasure buried underground. The problem is that nobody has actually found any treasure yet. OpenAI carries a $500 billion valuation, yet their actual revenue is only approximately $12 billion. Even more troubling is that they're operating at a loss every single month. This is the fundamental issue I see. AI services aren't generating sufficient profits yet. So here's the million-dollar question. Will these AI companies eventually produce profits large enough to justify their valuations? Potentially. They do have significant profit opportunities ahead. Consider this. Over 700 million people interact with ChatGPT weekly. That represents an enormous audience. And even more valuable, massive amounts of data about human behavior and preferences. Picture what happens when they activate advertising. Imagine brands paying to recommend products directly within your ChatGPT conversations. The revenue potential is enormous. Beyond that, these AI companies are constructing systems specifically designed to replace human employees. Their bet is simple. Once businesses become dependent on AI, they'll have zero choice but to continue paying, regardless of cost. That's when AI companies can dramatically increase pricing and finally generate the profits everyone's expecting. So yes, these companies hold genuine value, but that value hinges significantly on one critical assumption: that AI development will maintain its current rapid pace of improvement. Which brings us directly to the third and final warning sign.
Warning sign number 3, the data shortage crisis. AI development has advanced at an absolutely blistering pace recently. The progress from those early, nightmarish AI-generated videos to today's near-photorealistic results has been remarkable. Wall Street is betting heavily that this acceleration continues indefinitely, but there's a significant obstacle ahead. It's called the data wall. Here's what that means in plain English. For years, AI systems have been learning by consuming every piece of publicly available information on the internet. Current projections suggest that by 2027, AI will have processed essentially all human-created content online. Think of it like ascending a ladder. Everyone's assuming that ladder extends upward forever, but we're rapidly approaching the top rung. Consider the time span required to create all that data we've been feeding into AI systems. We're talking centuries of accumulated human knowledge. Books, scientific research, historical documents, spanning hundreds of years. That's why AI progress appeared so rapid. We've been feeding it the entirety of recorded human knowledge. But once AI exhausts new training data, development progress could decelerate dramatically. When that happens, investor expectations could crash, and the bubble everyone's invested in could finally pop. So the crucial question becomes, can AI overcome the data wall? Maybe, but it's far from certain. Consider how humans acquire knowledge. We don't just absorb information from books and articles. We learn through direct interaction with the physical world. We learn from lived experiences. AI hasn't experienced actual life. It hasn't had genuine conversations beyond responding to user prompts. It hasn't made real mistakes and learned from concrete failures. Our human perspectives emerge from authentic experiences, something AI cannot replicate yet. In my view, breaking through the data wall is theoretically possible. But it's not simply about accessing more data. It's about accessing fundamentally different types of data and teaching AI to learn through methods that mirror human learning. But listen, I'm not an AI researcher or computer scientist. So let's shift back to what matters most: your financial future and the actions you should take. Earlier, I drew comparisons between today's AI situation and the late 1990s dot-com crash. But are they truly identical? Not exactly. The crucial difference is that AI companies are solving genuine problems. They're providing real utility, and they have legitimate pathways to profitability. The magnitude of those eventual profits remains uncertain, but this is fundamentally different from the dot-com era, when companies received billion-dollar valuations based solely on having .com in their name. So does that mean we're not in a bubble? Honestly, I think we are. All the classic bubble indicators are present: inflated valuations, questionable revenue practices, geopolitical competition driving irrational spending, and potential technological limitations ahead. The challenge is, nobody can accurately determine where we are in the bubble's life cycle. We could be at the beginning of a decade-long wealth creation phase, or we might be much closer to the collapse than anyone realizes. So what should you actually do with your money? Let me emphasize, I'm not a licensed financial advisor, but if I were in your position, here's my game plan. Strategy 1. Maintain consistent investments. If we're early in the bubble, today's prices might look incredibly cheap in hindsight. This is why setting up automated monthly investments into a broad, low-cost index fund is so powerful. Smart investors did exactly this during the dot-com bubble. Yes, they watched their portfolios decline when the crash hit. But most don't regret it whatsoever, because given enough time, markets historically recover and reach new highs. The most crucial skill is having emotional discipline when your portfolio drops. If you're investing in a diversified index fund tracking the broad market, continuing to invest during crashes might be the best wealth-building decision you'll ever make. This is precisely how many people generated millions from the dot-com collapse. They bought aggressively while everyone else panicked and sold. But executing this strategy requires being debt-free and avoiding leverage. That's exactly why some people lost everything while others multiplied their wealth during past crashes. Strategy 2. Grow your earning power. Your income is the engine driving wealth accumulation. Increasing it, whether through career advancement, job changes, or launching a side business, will dramatically accelerate your results. This is especially powerful during market downturns when you're purchasing assets at discounted prices. Strategy 3. Spread your risk. Concentrating all capital in one investment type is financial suicide. Surviving market bubbles requires spreading your wealth across multiple asset categories. Consider holding a mix of stocks, bonds, physical gold and precious metals, real estate properties, and yes, even some cryptocurrency exposure. Also research dividend-paying stocks. These tend to perform well during economic downturns because they generate passive cash flow regardless of price fluctuations. So look, this bubble bursting won't be the end of the world. It won't lead to an apocalypse. Understanding market cycles like this one means you won't be the person frantically panic selling. Instead, you'll be the person calmly capitalizing on opportunities while everyone else runs for the exits. Markets reward those who remain level-headed, stay educated, and maintain composure when chaos erupts around them. If you want to learn more about how to benefit from a recession, I'm working on another video that will break it down step by step. Make sure to turn the notifications on so you don't miss out. If you're serious about building wealth and understanding how financial markets actually operate, join the Wealth Guide community by subscribing to the channel. Thanks for watching, and I'll catch you in the next video.